We're going to start out by looking at light crude. This is the light crude chart, and we're looking at a 10-year weekly chart right there. And what we're going back to is 2016. And just so that you understand the type of analysis we do, this is cycle analysis. This is a 10-year weekly chart, though we're only looking back about 5 years, or a little less. And I want you to notice these half cycles, these half moons on the bottom. These are called cycle brackets. Each one of these big ones is made up of 4 smaller ones. These are minor quarter cycles in here on these weekly charts that we're looking at. And there is a very clear cyclicality in here that I want you to notice. And that is that each of these big ones right in here is made up of 4 smaller cycles that are quite visible in here. So these minor quarters are significant. When you get to the final stages of a cycle, where they nest, the small one and the big one, is where you often have your largest declines. You can see this one right in here as oil fell from about 53 to about 42. You can see this one right over here where they nested, and oil fell from this peak here at 77 down to this level over here at about 42. And I want you to note that this decline comes in the 3rd cycle right over here after the breakdown. Now I want to just look at this bigger cycle right in here so that you can see what we're looking at. And what our charts showed us was that there was some resistance up here, and that these cycles were moving basically sideways. You can see that right in here. And when this one broke down below that key cycle support, it set up this major break. We alerted that this wasn't a good thing when it broke there and there was downside risk. There is no way we could have known, other than the risky period in here, that there was a potential for a decline. In fact, our analysis was suggestive of the fact that there was a bottoming likely to come in here, but we didn't understand that OPEC was going to fail and there was going to be a capitulation. Now we're down at the bottom of this 3rd cycle that you can see there, with a likelihood that there's going to be a rally. Now, resistances in here are about, at this area, of about 36.5 for that lower intermediate 23 that you see there. That is, just put this back in place right over here, that is the 23.6% upward correction of this entire distance to this overnight low down here that was under 28. So that gives you a potential rally period in here, but remember, we're coming into this 4th cycle, and it means that this sell zone in here is likely to stop any kind of a rally, and they're going to be moving down sharply again. So there's a major cycle support right over here at about $26 there. That would, this one right over here is the intermediate 100% fib extension. It got through there, right there. It's possible that, it would hold if it rallied, but it's much more likely that we're going to fall to $26 or lower. I just want to note that Goldman must be looking at the same chart, because Goldman is calling for a price of $25. So it got down into the 27s overnight. We're rallied back somewhat right now, down 10% on the day. 24% on the day, $10. And our projection would be probably moving down into July. Now, July is a time period we expect the stock market to be making a bottom also. So this is kind of in line. We call that synchronicity in markets. And a move down to 26 is likely. What does that say about the market? It says that this whole period over here into the summer, spring and summer, has got a ton of risk, and rallies are likely to fail. Now that's the weekly chart. Let's move into the daily chart right over here, and you can just see, let me just look at these last 3 cycles right in here. What we're looking at is this one right in here, actually late on this capitulation on the downside. Look at the volume in here, actually at just record levels coming up right now. And this right over here, we call that a hammer bottom, and that's very likely a bottom. So what we project is a rally up here into the high 30s, potentially getting up here to about $41. $10, I doubt it. Much more likely that it's going to get up into these areas here and then fail again. So if you look, we talked about a low in July, right? Well, this low right over here is only April. So that shows you there are many cycles out there coming into July that are going to have a ton of risk in them and big volatility in the oil market. What are some of the evidence is that the oil market has been crippled, absolutely done. The energy markets will try to hold together in here. You probably will see natural gas do better than anything, because with the shale producers under huge stress and probably not producing because they lose money on every gallon they produce, they would be a source of natural gas being produced as they do that. But that is not going to happen. So there will be less natural gas out there. So natural gas could do much better than the rest of the complex now, and we were looking for a bottom in it. Some of the evidence is that energy will continue to have problems out into July, and even though it might rally up into the high 30s for light crude, that it's pretty likely that continued downward stair-step pattern will continue.